Okay, so hi guys, welcome to this session, to the first practice session of financial reporting FR exam. So today we are going to do one of the very important questions from a very important syllabus area, that is group accounts. Okay, and the agenda for these practice sessions is not about solving all the questions of the kit. No, it is more about solving the substantial or the questions from every topic, so that you know that how to go about the question in the computer based exam environment, and how to read a question, how to present your answer, and how to take care of your time. And there are some slightly difficult things in one question, tricky things. So sometimes we need someone to guide us through one or two questions, and then we do the practice ourselves. So this session, the agenda for this session is same. So from each topic we will be doing 2 to 3 questions, and then we will be solving like all the important questions of the kit, whether it is an MCQ, whether it is a long question from group account, single entity, cash flow, or from the the KPIs, or you can say the ratio analysis. So all of those questions we'll do, we'll get a way of how to think, right? So these practice sessions are not at all a substitute for your own practice. You have to practice stuff on your own. Now this question which I have chosen, the 377th question of your Kaplan kit, this question requires a lot of time management. So what is required out of you is to learn to manage your time. And how to learn that? So this question is for 20 marks, and I know that ACCA recommends 1.8 minutes per mark. That means it will come out to be around say 36 minutes for this question, 20 into 1.8. So I should aspire to manage this question in 36 minutes. Now that can happen by practicing a lot. Okay, it will not happen in the first instance, it will take time. You have to keep on practicing. Practice it on the Excel, because there's no way that you will give this skill level exam on the paper. So practice it now on Excel, and try to solve as many questions as possible. So this is just the beginning. There is a lot of days which are remaining to your exam now. So it's more than around 40 days or something, if I'm not wrong. So we have a lot of time to practice, and the sessions will be 14 to 15 hours of question drilling of the kit, all the important questions, all the syllabus areas being covered. Okay, so let's not waste the time and start with the question. So the first question which you have here is the Viajum question. I'm going to call it as V. Okay, so this is a very important question here. And how to go about a question is to first read the requirement. Don't ever forget to read the requirement first. Don't just jump to the question and see, oh, what's there. No, first read the requirement. So the first requirement says calculate the consolidated goodwill at the date of acquisition of Gresa. So Gresa must be the subsidiary. That's why they are asking me to calculate the goodwill of Gresa. So prepare the consolidated statement of profit or loss for Viajam for the year ended 30 September 2002. So if my year is ending on 30 September 2002, one thing I need to make sure is that I draw a time scale. So in my mind, so 30 September 2002. So after September comes October. So year must have started on 1st October 2001, and it has ended in 30 September 2002. So 1st October 2001 till 30 September 2002. So what is the date of acquisition now? Let's look into that. Date of acquisition. Okay. So the date of acquisition is 1st January 2002. So from 1st October, bring it in your mind. From 1st October 2001 till 30 September 2002. When does January 2002 come here? January 2002. Okay, so 1st October till 30 September. So January 2002 must be somewhere here. So it's 3 months after the year starts. So midway through the year. Acquisition is midway through the year. 3 months after the year starts, we are acquiring a subsidiary on 1st January 2002. So what is the post-acquisition period? Post-acquisition period is from 1st January 2002 till the year end of 30 September 2002. So that is January, don't hesitate on counting it on your fingers. January, February, March, April, May, June, July, August, September. 9 months, right? So 9 months is the post-acquisition period. Good, understood. Then they say that we acquired 90% of the equity share capital of G in a share exchange in which we issued 2 new shares for every 3 shares it acquired in Gresa. So they are, particularly talking about the consideration transferred. Here they're talking about share for share exchange. So V is the parent, G is the subsidiary, and we acquired the shares in G for share exchange. So we said, take my shares, I'll take your shares. That's what they agreed upon, right? So that is share for share consideration that you will deal with in the consolidation goodwill calculation. Okay, so let us now prepare our response box. Let's go to our response box. This is I have formatted. Okay, so first requirement asks me about goodwill calculation. Then I'll write here that it is going to be in dollars, thousands, and then let's prepare the kind of a pro forma. So my pro forma is consideration paid. I don't know what consideration is paid. It could be deferred, it could be share for share exchange, it could be contingent. So I have not read the question yet, so I don't know how many lines, or you can say rows, it will take to fill this part. So let's just leave a good number of rows for that. Okay, and then write the requirement B. So requirement B is consolidated statement of profit and loss, right? So that is my consolidated statement of profit and loss, and it is just a copy from the question, the pro forma. First comes the revenue, then comes the COGS, cost of goods sold, which will give me my gross profit. Then let's see what all items are there except this in our question. So in question we have the distribution cost after the gross profit, distribution cost, administrative expenses, finance cost, and then investment income. Okay, so you're gonna write, leave a line, distribution cost, admin cost, I'm writing the short form, finance cost, and then investment income. And don't close this, because it's not sure that this is just the element of statement of P&L, because we have not read the additional information yet. So we won't close it, we'll just leave some space, because in the exam we cannot add rows or columns to the top, bottom, left and right. It's just here on this Excel sheet, but it's not present in the exam, right? So make sure you don't do that. Leave ample of space. The examiner won't mind the space being extra. Okay. Then because I know I have to allocate the profit towards HCI and parent as well, so I will leave a lot of space here, and then I'll write working notes. So I don't know which working notes will be prepared. We'll do it later. Now let us solve the goodwill calculation. So the consideration paid, first of all, I read it in the first line, it was share for share exchange, where they are saying if we go to the question again, they're saying that, read this, on 1st January 2002, we acquired 90% of the equity share capital. And what is the equity share capital of the subsidiary? G. Equity share capital is given here. It is 10,000. And what is 90% of 10,000? That is 9,000. So we acquired 9,000 shares of subsidiary. And what is the price which we paid? We paid 2 new shares for every 3 shares. So 2 new shares for every 3 shares. Just a quick question for you. You have 6 chocolates right now, and I said that I will be giving you 2 new chocolates, 2 more chocolates for every 3 chocolates that you have. So how many new chocolates will you get? Yes, right. You will get 4 new chocolates. So how did you calculate that? We thought it was so simple that we didn't follow any formula or something. No. So you said I have 6 chocolates. I will get 2 new chocolates for every 3 chocolates already I have. So you said 6 into 2 by 3. So for every 3 chocolates I have, that means how many sets of 3 chocolates I have. So how many set of 3 chocolates I have? I have 6, 6 divided by 3, I have 2 sets of 3 chocolates. So I will get how many chocolates? For one set I am getting 2. So for 2 sets I will get 4. So you said 6 into 2 by 3. That was your calculation which you calculated came out to be 4. Okay. So similarly here we have V, that is the parent, has given out 9,000, you can say has taken 9,000 shares and is promising that he'll pay 2 new shares for every 3 shares he get. So he's getting how many new shares? Or he's paying out how many new shares? He's paying out 9,000 into 2 by 3. And at what price? At the market price. And what is the market value of the shares of the parent? Because parent is paying out its shares, so you will take the price of the parent. So this line states that at the date of acquisition, shares in V and G had a stock market value of 6.5 and 2.5 each. So you will take 6.5. So what is your share for share exchange calculation? Don't forget to mention it here as well. That will give you marks. So you can write 9,000, don't do it in your head itself, write it out so you get some step marking as well. 9,000 into 2 divided by 3, and that is being multiplied by $6.5, right? So that is what I am getting. So you can just calculate it in your calculators. It must be coming out to be 39,000. Right? Then what else I have? Let's read the question for that. Now they're saying that additionally on 31st December 2002, we will pay the shareholders of G 1.76 shares acquired, and cost of capital is 10%, deferred consideration has not yet been recorded. So parent is going to pay the subsidiary more, but it will pay after 1 year, 1 January 2002, 31st December 2002, after 12 months. So that is a deferred consideration where we have to take into account the present value of the consideration. So in this case, what is the present value? You will calculate it. You'll say how many shares are we buying, or is we buying. Deferred consideration. Deferred consideration calculation would be 9,000 into this 1.76. Okay, so 1.76 per share they're saying, and how many shares we have is 9,000, divided by the discounting factor, that is 1.1. 1 plus 10%, so 100 plus 10%, that is 1.1 to the power 1, because the gap is of 1 year. So how much is it coming out to be? Let's calculate it. Okay. Okay, so this is coming out to be 14,400. 14,400 is my deferred consideration, right? Then let us look into the next aspect of our question. Yes, 14,400. Okay, now the next aspect is, of course, let's read the question for that. Then they've given you the statement of profit and loss. So for goodwill calculation, what else do we need? We need non-controlling interest. So how do we calculate goodwill? We say whatever was transferred to the subsidiary by the parent for 90% of the subsidiary, by the NCI for 10% of the subsidiary, versus what the subsidiary deserved. That is the fair value of net assets of the subsidiary. So we compare these two things: consideration paid by the parent and the NCI for the 100% of the subsidiary, with the fair value of net assets of the subsidiary, and that gives us the goodwill amount, right? So here I have calculated whatever was paid by the parent, for 90% of the subsidiary. We've already calculated that. Now we will calculate what was paid by the non-controlling interest. Okay. NCI for 10% of the subsidiary. What is the amount being paid? So the shares held by NCI is 10,000 minus 9,000, 1,000, into how much? Into the share price of the subsidiary. What is the share price of the subsidiary according to the question? Here it is $2.5. So you'll write it $2.5 into 2.5, which comes out to be 2,500. Right? So what is the total consideration being transferred to the subsidiary for 100% of it? It comes out to be equal to this plus this. Okay, wait a second. Plus this, right? All of them. So this gives us 55,900. Now let us compare this 55,900 with the net assets of the subsidiary. So net assets, or you can say fair value less fair value of the net assets of subsidiary at acquisition date. Now when I say at acquisition date, we used to prepare a different working note for this when we were preparing SOFP, but here we are not preparing the SOFP, we are preparing the statement of profit and loss. So we will not make a special working note. We can show our workings here, it will save our time. So I'll write here what comes under the net assets. Assets minus liabilities, the net asset, equity section. So it comes, share capital comes under this. The retained earnings will come under this. Retained earnings at acquisition date. And what is the acquisition date? Acquisition date is 1st January 2002. So what is the retained earning at this date? And what else? Any fair value adjustment, if it is there, will be added up here. So extra depreciation, additional depreciation will be deducted from here, right? So let us just see the question for that now. Okay, so they have given you the share capital of the subsidiary. The share capital is 10,000. So let us write there 10,000 share capital in brackets because it is less the fair value, right? Then retained earnings at acquisition. What retained earnings are we given? We are given retained earnings on the opening date at the start of the year. That is 35,000. Then The year started at 1st October 2001. Acquisition is happening on 1st January 2002. So there are 3 months, October, November, December. So what is the profit for these 3 months? We'll see the profit for the year is 6200. For this year, the profit is 6200. And what will be the profit for if we evenly accrue it? So 6200 divided by 12 into 3. That will be your profit for 3 months. So you'll say, let's just do it quickly here. 6200 divided by 12. So 517 into 3, 1551. Okay. So 35,000, you can write it here in the brackets. 35,000 plus 1551. Let me just confirm this out. Okay. So yep. Is my calculator. $6,200 divided by 12 into 3. Yes, 1551. We can approximate it to 1550 as well. So you can write here 1550 and make sure you erase this part. Okay, so this is coming out to be how much? 35,000 plus 1550, that is retained earnings at acquisition date. So it should be deducted again. Right. Then what we have is the fair value adjustment or something. So let us look for that. Let's read the question. So it says that at the date of acquisition, the fair value of Gressa's assets were equal to the carrying amounts with the exception of 2 items. So for the subsidiary, all the assets value was equal to its carrying amount. So all the fair value were equal to the carrying amount except for 2 things. What are these 2 things? One is an item of plant had a fair value of $1.8 million above its carrying amount. So above its carrying amount 1.8 million. The remaining life of the plant at the date of acquisition was 3 years. Depreciation is charged to COGS. Cool. 1.8 million is my fair value adjustment. So 1.8 million can be called as 1800. So you'll say we'll deduct extra 1800 because from goodwill calculation we always say that net assets are being deducted, so that's the reason I'm deducting it. Then I'll add up the additional depreciation here. Okay, so I hope you're understanding that why I'm adding it, because here it is less, right? So what is the additional depreciation? Okay, it is 1800 divided by 3. So this additional depreciation will actually not come here because this will happen at the reporting date now. So this additional depreciation you can just calculate in the inner column, or you can just skip it and write here one note that don't forget to take additional depreciation to COGS. right? So don't forget to do that, because you're also preparing the statement of profit and loss. So you have to keep this in mind, that I have to take additional depreciation to COGS. So this is a star point. Okay, so make sure you have a note of it. So this is my fair value adjustment. And then what else do I have in the question? So you can put circle here, you can't do it in the exam, sorry. Okay, then Gresa had a contingent liability which we estimated to have a fair value of 450,000. This has not changed as at 30 September 2002. Okay, so fair value of contingent liability, IS 37. Contingent liability is not shown in the statement of financial position, it is just disclosed. So it's not there in the subsidiary's financial statement of financial position, but IFRS 3 tells me to include this contingent liability in the calculation of goodwill. Because when I will acquire that subsidiary, I will be taking up all its liabilities. I'm not just happy taking its all the assets. I'm also sad because I will have to pay back all the liabilities which the subsidiary has, right? So I hope you're getting that vibe, that you'll have to pay the liabilities of the subsidiary. So you have to take into account contingent liability as well. In future, if something happens to the subsidiary, the same thing will happen to the parent. So this 450,000 should be there in your goodwill calculation, contingent liability. Now contingent liability is an increase in liability. If it is an increase in liability, that means it reduces the net assets. So contingent liability which reduces the net assets will actually be added here, because already there is a less here. I hope you're understanding this part. So what it is 450, right? So let us calculate the fair value of net assets of the subsidiary as a whole now. It'll be, okay, let us just calculate the goodwill. It will be 5590 plus all of them. Oops, this happens to me a lot. Okay, this plus this plus this. 17,000 is the goodwill. I hope that is the amount. Okay, there's some error here. Just a second. Okay, so just for your clarity, it is 55,900 minus it's not 1,000, it's 10,000. That's the mistake. Don't do this mistake in the exam. Okay, so again, this plus the all these cells, yeah, so that is your goodwill, 8,000. So we are done with the 7-marker question here. We've calculated everything, and the only thing which you need to keep in your mind is this additional depreciation, which will also go to COGS. Okay, then let us move to the statement of profit and loss. Let's read the question more. Now, GRESA has not incorporated these fair value changes into its financial statements. We are anyway not preparing SOFP. Then V's policy is to value the non-controlling interest at fair value at the date of acquisition. We already did that. So for this purpose, GRESA's share price at that date can be deemed to be representative of the fair value held by the NCI already dealt with that. Then the third additional information is sales from V to G. Okay, this is important. Sales from V to G throughout the year ended 30 September 2002 had consistently been 800,000 per month. Okay, and we made a markup on cost of 25% on these sales, and Gressa had 1.5 million of these goods in inventory at 30 September 2002. So let us calculate the PURP, provision for unrealized profit. Let's make that working note. PURP. Okay. So every month how many sales were made? $800 sales. How many months are there? 12 months are there. So intra-group sales were equal to 800. If we work in thousands, 800 into 12, that is 9600. Let's just confirm it once more. Okay, consistently being 800,000 per month, and a markup on cost of 25% markup. So how will I take into account this markup? It's up to you. Some people use this formula of 25 divided by 125, but I don't believe in this cramming stuff. So I will always use that X method. Okay, so I use this linear equation where I say that let the cost be X. So X plus 0.25x is equal to how much? 9600, right? And that means 1.25x is equal to 9600. That means x is equal to 9600 divided by 1.25. And what is that? That means x is equal to 9600 divided by 1.25. 7680 is my cost and sale is 9600. So what is my profit on intragroup sale? The profit on intragroup sale is 9600 minus 7680. That is 1920. But what is the unrealized profit here? PURP. Now they're saying out of the 9600 of the sales which we've made, only they can say 1.5 million is remaining, that is 1500 is remaining. So that means only how much is the unrealized profit? It is 1500 divided by 9600 into how much? Into the profit, that is 1920. Cool. So how much is that? Let's do it quickly on our calculators. 1500 divided by 9600 into 1920. So that is coming out to be 300, right? So that is coming out to be 300 PURP. So this is how I calculate this PURP. I know it is complex and stuff. And another way is just to simply do 1.5 million into 25 divided by 125. That is more of a rectification, but the rationale behind that is this X equation, right? So this is the PURP. Then what do we do for the PURP? You know, let's move to the former. We add the PURP in COGS. So add PURP. And what is your intragroup this thing? revenue and intragroup purchase. So your intragroup revenue is how much? Okay, so my intragroup revenue is 9600, right? So I'll say deducted from revenue. And deducted from COGS. This will add PORP here. PORP is 300. Okay. Now let us move to the question again. Then the next point says that V investment income is a dividend received from its investment in a 40% owned associate which it has held for several years. So the underlying earnings for the associate for the year ended 30 September 2002 were 2 million. So now they're saying the investment income which the parent has, that is the income which he has got from the associate. So I will not include that, just the dividend which I have received. I have to include all of my share in the associate. The parent will include all of the share in the associate. So what is the profit of associate? That is 2 million. And what is the share of the parent in that profit? 40%. So my income from associate, there will be a new thing which will be added rather than investment income. It will be income from associate. How much is that? 2 million into 40%. So you can write here directly 2000 into 0.4, that is 800. That is your income from associate. Then for revenue and everything else, let's read more. Now, although Gresa has been profitable since its acquisition by V, the market for Gresa's product has been badly hit in the recent months, and V has calculated that the goodwill has been impaired by 2 million as at 30 September 2002. So we can go back to our goodwill calculation and impair the goodwill by 2 million. So let's move to our first requirement here. Then we'll write here goodwill impairment. Deducted by 2000. So this will come out to be this 6000 is your goodwill, which will go to the statement of financial position. Okay, so income from associate is here and everything else is here. Now let's just add up the things normally. Don't forget this is a mid-year acquisition. So what we are doing here is we are deducting the whole 9600. But this acquisition happened midway through the year after 3 months. So we should only deduct 9600 into 9 by 12. That is what you should deduct. So I won't write the whole thing here. Let's do it on a side. 9600 into 9, and that is 86400. 86400 divided by 12, 7200. So 7200 is the revenue which you will be deducting, not 9600. But for the PORP calculation you have to take 9600 only. Okay, so 7200, the revenue, intragroup revenue after acquisition, that is 7200. Then what is the parent's revenue? Parent's revenue from the question. Okay, so the parent's revenue is 64,600 and subsidiaries is 38,000. So you can simply just write here 64,600, the whole of it, but subsidiaries after acquisition 38,000 into how much? 38,000 into 9 by 12. So what